Well, as we just heard, Australia's biggest contractor, Leighton Holdings, surfaced from its self-imposed trading halt to be confronted by its once loyal investor base heading for the lifeboats. Leighton's extensive workbook was suddenly deemed to be deeply underwater, and a forecast $480 million profit had sunk to a $427 million loss that needed a deeply discounted capital raising to plug the balance sheet hole. Now, Leighton's plunge into the red is just one of a series of misfortunes blighting the Australian construction industry. While they have a variety of causes, they share one thing in common: a complete miscalculation of risk in a very risky business. Neil Woolrich reports.
It's one of the biggest infrastructure projects in Victoria's history and touted as a cure for the state's water worries. It was also meant to be a lucrative earner for the firms building it. But in a cruel twist, the Wonthaggi desalination project is now behind schedule after the wettest Victorian summer on record and dripping red ink.
This is the most serious challenge faced by the Leighton Group in the last 20 years. And we apologise to the shareholders for the situation that they are now in.
Leighton Holdings this week revealed a $280 million write-down on the desal project, along with a $470 million loss on Brisbane's airport link. What was expected to be a $500 million profit this financial year is now forecast to be a $427 million loss. That's forcing the company to raise $750 million in shareholder funds.
The risks on these projects are high. I have implemented a review of these projects, and we're changing the way we tender these projects, effective immediately.
The use of fixed price and time contract structures was always going to carry a lot of risk for the contractor. Leighton's accepted those contract terms, and as it turns out, they haven't adequately priced their bid accordingly.
Leighton is just one of several engineering and construction firms to have fallen well short of expectations on big contracts. Downer EDI has written off $440 million on its Sydney Trains project over the past year after being plagued by production delays. And McMahon Holdings, which is part owned by Leighton, booked a $50 million loss on its Pilbara Rail project for BHP Billiton. That's led to hefty share price plunges for all three companies over the past year against a flat market, despite operating in a space that was supposed to be reaping windfall gains from the mining boom.
To me, there's no systemic issue. Otherwise, that would be a horrible outcome for Leighton. We believe it's very locally associated with PPPs, complex jobs, tight timeframes, which is Airport Link and Vic Desal.
What's in their control, obviously, is the ability to restore their capital structure with this equity raising, to actually improve their financial metrics post the equity raising and provide themselves with enough cash within their company to withstand further shocks, should they be forthcoming over the next 2 to 3 years.
Leighton now expects to miss its first milestone on the Wonthaggi desalination plant to produce water by the end of the year. That's being blamed on the weather. But others say the cost overruns are because the builders struck a bad deal with the unions.
The industrial relations deal that was done for that in 2009 is 30% above the standard wage rates for construction right through Australia at the moment. So we've got this cost escalation happening there quite quickly.
People have raised their eyebrows at the nature of the labour market outcomes in Wonthaggi, and I think people need to know that these markets have to be studied very carefully. There was a problem of union power in Victoria. There is a problem in the construction sector in Victoria.
While there's a growing number of firms that have struck trouble with public-private partnerships, the days of the PPP are far from numbered. What's needed, though, is an appropriate allocation of risk between governments and the private sector and a stable policy framework.
A piece of infrastructure like a toll road also delivers economic and social benefits. So I think governments need to take that into account when they consider how much risk they're willing to retain.
I think the crucial thing is the predictability of government policy in terms of toll setting, indexation, in cost factors. If they just all of a sudden change the arrangements in the labour market such that they can't anymore bargain for direct enterprise agreements, then that affects things.
And Michael Porter says firms should be able to compete with unions by using contractors.
Including by using contractual models that work well, that give people the right to negotiate flexible terms and conditions. And I think most people are very worried that Julia Gillard's government is backpedalling on labour market reforms and that this is inflating costs.
They have to look at these industrial relations deals and say, all right, government, if this is the deal that we're going to have to take, well, you take the industrial relations risk, not us. In other words, all sorts of escalation clauses relating to industrial relations issues.
And Ken Phillips warns that every government's infrastructure budget is now at risk. That includes the biggest public infrastructure project of them all, the National Broadband Network.
Whether or not they can get a deal in place, an industrial relations deal in place that enables them over a very long period of time to have sufficient flexibility, adaptability and creativity with the way labor's used, the cost blowouts in the NBN promise to be huge.
Already the industrial relations deal at Wonthaggi is being used as a benchmark for other work around the nation, potentially also stifling the mining boom.
The deals in terms of the construction of mines are still being put together. They're not all locked in at this stage, and if we're looking at industrial relations arrangements that really make the cost of those projects prohibitive, well, we could see a squeezing of the mining boom and not getting the results that we need out of the mining boom.
For its part, Leighton Holdings will also appoint a senior executive to put a price on risk.
We're going to take a risk. If we don't understand the risk, we're going to put a price on the table. And that's it. I mean, Leighton has the ability to deliver these big projects, but we're not going to lose money doing them. It's just not in the interest of the shareholders or the company.
In other words, the cost of major projects is about to get much more expensive.